Hello and welcome to BQ Prime. Banks in the United States and Europe have been under significant pressure over the last 10 days. But last night, a deal was cracked between UBS and Credit Suisse, and now there is hope that some calm may finally prevail. Joining us today to discuss the ongoing situation is Mr. Ajay Shah, co-founder of the XKDR Forum, a economic and policy research organization that is based out of Bombay. Thank you so much for joining us, Mr. Shah, and making the time to speak with us. Just before we sort of start off into the details, I've been watching the events of the last 10 days with peeled eyes. I'm sure you've been, and other participants in the financial ecosystem have been as well. Anything that stood out to you in specific about the last 10 days? What was your first reaction to it, if I may ask?
A couple of reactions. The first was that when the US Fed hiked all through 2022 in ways that pretty much had not been seen before, I always knew one general insight, which is that when things happen in the world that have not happened before, there are unexpected failures of our mental models, our frames of reference, our statistical models. So things were going to break in ways that we hadn't thought about. Okay, that said, Silicon Valley Bank seemed like an astonishingly simple story. How hard is it to do risk management between short dated and long dated? So that just struck me as being like an obvious place where things went wrong. Finally, it was really curious and interesting how the level of risk on account of the flight of deposits has been amplified when you bring two things together. First, when you actually don't have true retail depositors, but you have fairly affluent people with large value deposits. These are the people who are the most terrified by the deposit insurance limit, and they react rapidly and take their money out. And the second is the role of modern information technologies. We have to remember that all said and done, in 2008, the level of interconnectedness of the world was lower than what we see today. So these two factors came together to create a run on a bank, the likes of which had not been seen before. So these were some of the surprises that we saw around SVB.
Okay. Now, because we've seen the turmoil play over across multiple banks, right? 3 banks in the US alone failed. Credit Suisse was close to that situation, but then it was rescued through a deal with UBS. Would you say that this is a part of disinfecting some problems that have popped up in the financial system? Or do you think these are broader symbols of an underlying problem cropping up that we will need to address in the future?
I think a couple of things. First, monetary policy works by making some things break. We would like to make it more orderly and more regular. Sometimes it becomes more disorderly and more irregular. But the basic story is clear. We've got to raise rates. We've got to fight inflation. The Fed acted late. The Fed should have started sooner. Okay, so if I had to go back in a time machine, really, what I would say is that the Fed should have started sooner. Then it could have been more measured in its steps. Okay, there were mistakes made in monetary policy, but I think everybody agrees on the basic point that the greatest contribution that a central bank can make is to deliver low and stable inflation. And inflation has been at unacceptable levels in DMs, in developed markets. So this unprecedented Fed tightening in 2022 took place, and then things were going to go wrong. Now, you can't predict precisely what will go wrong. There is a great internet debate about, was SVB stupid, or were their regulators stupid, or was the Fed stupid in raising rates so quickly? I would encourage a little more charity towards all concerned. We should think statistically. There are thousands of banks in this world, and each of them have some peculiar combination of factors at work. So when you get the unprecedented Fed hikes of 2022, some things were going to go wrong. And it's just dumb luck, which is the precise organization where things go wrong.
Indeed, understood. But as you said, we need to be a little more charitable in our, hindsight is always 2020, but you're saying we need to be a little more charitable. Would you also be more charitable towards the sort of investments that these banks were making then? Because maybe they just thought interest rates were going to stay lower for longer.
Yeah. So see, again, statistically, different people have different views. That is the meaning of a free economy, that you may be, incredibly negative about Nifty, I may be
Hmm.
incredibly positive about Nifty.
Sure.
These things happen. And ex post, after a big loss is made, yeah, of course, one guy was right and one guy was wrong. But that's part of life. So I don't want to overplay that. So
Okay.
it seems like there are some people who are hoping and dreaming that banking can be made safe and sound. I just want to push the bad news that banking is a disaster prone 19th century industry. It has gone through difficulty after difficulty forever. And I don't expect that to change. So if you're waiting for some world where banks will become safe and sound, then I think that's not a fair description of this world.
Right, that's a very interesting thought to take home at the end of a Monday when we've seen banks collapse across the world. The next thing I wanted to come to here is that last night, when Swiss regulators were announcing the deal of Credit Suisse being sold to UBS, they pointed out a peculiar thing. They said the turmoil that started in the United States with regional banks also spilled over into Europe and accelerated some of this process, if not caused it. I had two questions here. One, do we really live in such an interconnected world that a mid-sized bank in the US can topple over one of the world's best known, largest investment banks? Secondly, does it also require us to change our understanding of contagion risk now, if that is a possibility?
Yeah. So I would like to respond in two parts. The first is that, oh, yes, we're in a deeply interconnected world. Okay. So India is one of the last backwaters of the world where there are so many capital controls, there are procedures, there's some OTP, there's some KYC. Okay. All this stuff is only in India.
Okay.
The advanced economies are immensely integrated. You truly live in a globalized world where people effortlessly do business and travel across countries. So imagine there's no country is a reality in developed markets, something that we in India can scarcely believe. So we are a very backward country on some of these things.
Okay.
Second, it's not just about interconnectedness, it's also about the richness and complexity of the modern world. So let me take you back to 2008 as an example.
Sure.
At the beginning, if somebody had told you that, had somebody had told me that, look, there is a problem in the United States, there's a small sector which is called securitization paper, which is unusually high risk. Okay, it was a small asset class, it was about $500 billion. It was not serious money compared to the global economy.
Sure.
You would have predicted something localized brewing out of that.
Right.
But the network of relationships of the modern world are very complex. And the way things are interconnected and X leads to Y and Y leads to Z is often easy to see in hindsight and difficult to see ex ante. So I think both these phenomena are at work. So in the case of Credit Suisse and SVB, in my opinion, perhaps it was not that unpredictable. Okay, I tell a story something like this, that for a while now, through 2022, Credit Suisse had been the focus of a lot of pressure.
Yeah.
By the way, the CDS, the credit default swap of UBS today, is exactly where it was a couple of months ago. So it's not like these organizations were not under trouble at various points in 2022. There has been a lot of concern about the way Credit Suisse had been functioning. And this was the last straw on the camel's back. Now let's play the logic. The Silicon Valley Bank blew up. It was a remarkable phenomenon that the US FDIC chose to go away from its rule book and ensure all deposits completely. In any reasonable world, that need not have happened. Now, people with large deposits in any bank all over the world start looking at each other like, really? Should we be holding so much money in our bank? Are we so sure that this stuff is sound? Am I not better off in a money market mutual fund or in another bank, which is extremely safe? So money starts getting yanked. Okay. Further, this roils the market, the WIX goes up. So access to short-term financing for Credit Suisse becomes more difficult, their equity value goes down. So this, I felt, was a reasonably predictable domino that if you get a mess in the United States in a couple of large banks, it doesn't surprise me that Credit Suisse was going to get roiled in the trouble.
Understood. Now, the next thing that sort of brings me to, and you mentioned this briefly, that whatever happened also happened very quickly, right? Like SVB's deposits flew out of the window very quickly. CS stock dropped like a rock very quickly. Given the amount of interconnectedness you just highlighted, if you add a lot of speed to it as well, does that equation become even more complex to be able to comprehend for regulators, for everyday citizens like you and me, or even for people who may be working in these organizations?
Everything you say is correct, and I will now push one step further in the
Okay.
edifice that you are building. So it has consequences. We should be thinking more about how certain ancient business models work. So the fact that we have had a certain kind of incredibly leveraged bank all these years, it's good to start rethinking some of those foundations. As I said, the run on a bank in SVP was unprecedented. Never before in world history have you had so much money leaving a bank in such a short time. Similarly, through this weekend, with everybody empowered with a web browser and an electronic payment system, the money that has been leaving First Republic is remarkable.
Yes.
Okay.
Yeah.
So yes, everything you say is true. And it calls for us to think in new ways, that we have to find the right strategies and business models for this 21st century interconnected, high speed electronic environment. And I feel that this raises fundamental questions about certain old business models.
Okay. I also want to come to the fact that right now, at least in the US, we seem to be developing two categories of banks. One is, of course, the JP Morgans, the Bank of Americas of the world, who are so large that by default, their deposits are secure. And then you have your smaller regional banks. Any average citizen, as you said today, could ask themselves that question, what do I lose by moving to a bigger bank account? Like, I don't really lose anything. I may just get additional security on top. So in a two-part question, is it very important to preserve those smaller banks as well? And given the situation that we're witnessing today, especially with larger borrowers, how do we go about sort of preserving the existence of smaller banks as well?
But as I said a moment ago, it's important to start questioning some of these business models.
Understood.
So I think that this is a great reminder for everybody that money market mutual funds are a great thing. It's a reminder for governments and regulators that why have we tied payments so tightly to banking? Because banking is a troubled sector. Whereas if payments happened through money market mutual funds and Google, it would be so much safer. You would not have this difficulty that we have tied payments into the world's most highly leveraged industry and a troublesome industry. Why is that wise? Why is that optimal? So I think questioning the domination, or in some countries like India, even the monopoly of banks in the payment system is appropriate. If we move more in that direction, then I would not even take for granted the too big to fail guarantee that many governments have given to the largest banks. It's not a politically stable solution. Okay, so we get fresh outbursts of populist rage each time public money is used to help banks and their rich employees. In fairness, the shareholders and the managers of SVB got burned. But the depositors were equally rich people. They are the Silicon Valley gentry. And I think it's a politically bad situation to use public money to help rich people. And I say this for a narrow reason, because it is like pouring petrol on the flames of populism. Okay, the great problem of the world is the populism. It is the rage against the rich, the rage against the elite. It gives birth to all kinds of political and economic policy problems. So I think this is it's a bad deal, and we should be questioning this. And there is a clear way forward, which is in terms of reducing the leverage of banks, reducing the extent to which governments back the biggest banks, reducing the share and the monopoly of banks in payments, ... There are many directions to go, but the heart of it is questioning this 19th century conception of a bank.
Because we mentioned politics and populism, in 2008, when the bailouts happened, there's a lot of pushback against that as well. Yesterday, a deal was announced. Now, a lot of commentators did say it was a bailout. Some of them pushed back against it being a bailout. How do you see it, the deal with UBS and CS? And secondly, if it is a bailout, do you think the ghost of moral hazard comes back? I don't think it ever really went away, but do you think it comes back in bigger force?
It was a bailout in the sense that the US FDIC had promised $250K to each depositor. It dipped into its own balance sheet to pay more than that. Now, that's money that belongs to the FDIC. Yes, it was not money taken from the taxpayer, but this is money that belongs to the FDIC, which is ultimately funded by an insurance charge upon all the financial firms that it insures. So effectively, it's a transfer system that you've taken money from other financial firms to bail out this one. Yeah, there are concerns about moral hazard. If Yes Bank deposits are protected, why would a depositor leave their money sitting with a more safe bank like an HDFC bank? We are creating a systematic incentive for depositors to seek out the riskiest banks that offer a little bit more by way of their checking accounts.
Right. Yeah. Switching gears a little now, we've talked a bunch about financial contagion that could emerge out of these situations. I also want to talk a little bit about economic contagion, especially when we're talking about smaller regional banks in the US. If they tighten credit policy by a lot, if banks in Europe tighten credit policy by a lot, do you see an economic spillover that could maybe help reduce inflation, but also will have a dent on growth?
I want to locate this in the larger question of monetary policy strategy. The monetary policy strategy of the Fed was that in February 2022, the Fed decided that it was time to hike monetary policy in order to rein in inflation in the United States. Things going bad in the financial system is consistent with that strategy. You could argue that there were ways to get to this objective of reining in inflation while imposing less pain upon the economy. And you would be right. But the direction is not wrong. The direction is that DMs want to, DM central banks want to pull back aggregate demand so that they get back to the DM inflation target of 2%. So there's a very weird sense in which these developments are not inconsistent with the direction that DM central banks want to go.
Right. Okay. Yet at the same time, they're causing some pain.
So they are messy. There's more pain. So the way we should think about it is there was always going to be pain. Okay.
Sure.
So when the central bank raises rates and there is a crisis in Mexico, or there is a crisis in Thailand, or many homeowners default and have their houses repossessed, this is pain. So all central bank tightening imposes pain upon the economy. Now you have to indulge in a moral calculus about what kinds of pain are more appropriate than others.
Right. Okay, fair enough. Now, just to sort of close out our chat here, are there any sort of headline warning signals that you're watching, or like any headline indicators that you're watching ahead of the Fed meeting on Wednesday, and then before we close out the week on Friday, to sort of figure out where do you see the situation heading?
At heart is this debate. The Fed knows that inflation in the United States is too high. They have made no secret about their desire to get back to their inflation target of 2%. This is a proud, successful organization that for years and years was able to successfully deliver 2%. So it's not something that they take casually.
Right.
They want to go there. The kind of stuff I was saying, that is it better to calm down the financial crisis and then get back to the journey of fighting inflation, or do we take this in our stride and move on? That's the debate, and that's how people will see it.
But do you see inflation hitting 2% before the Fed has to pivot? Because the market is already pricing in cuts before the end of this year.
I personally will be surprised if you get to that. United States inflation is a tough cookie, and it would be quite an achievement if inflation in the US is back to 2% even by the November elections next year. That would be a surprise.
You're saying November elections next year, you could still be struggling to hit 2%.
It's a pretty difficult situation. So the heart of the debate is that is this an excessive amount of pain, and would briefly backing off help? Briefly backing off would also create very confusing signals for the entire economy that, oh, are you satisfied with 4% inflation? Which would
or what do you know that we don't know?
Yeah.
That could be
this is the really important debate that will take place. In favor of the hawks, there is one argument, which is that after 2008, there's been a tremendous improvement in the toolkit of financial stability. So the kinds of things that governments all over DMs are able to roll out today are because of the remarkable work done by Bernanke and his crew at the Fed at the time of the crisis. So there is much better understanding on the importance of a well-functioning financial system and on the kind of tools that are used. So my opinion is that this crisis will not turn into a big mess.
Okay, so you're not expecting a lot more pain down the road?
Yeah, it is my opinion that we are very well tooled up as DM central banks in fighting this.
Okay, understood. Mr. Shah, thank you so much again for joining us. This was a very, very insightful chat, as I'm sure it was for all of our viewers as well. And we thank you again for your time. And thanks to everyone for watching.
My pleasure.